Hello. Welcome to our next IND AS, that is your IND AS 16 property, plant and equipment. This is a very important IND AS and a little lengthy. So in our 50-page summary notes, this is approximately 2 pages. So let's just start with what is PPE, that is a property, plant, equipment. So definition of PPE goes like these are tangible items. Tangible items means items that you can touch. And then there are four parts. That is, first is it is held for use in production or supply of goods and services. That is, it is held for use. It is used. It is not itself consumed, but it is used for production or supply of goods and services. Next is it is held for rental or for administrative purpose. That is, say for example, you purchased a machinery and you rented it out. Third is expected to be used for a period of greater than 1 year, because if it gets consumed within a period of 1 year, it will become inventory. And last is it includes bearer plants. Now, what is bearer plant? Bearer plants are basically your trees or plants that give a fruit or a vegetable. That means they themselves are not chopped. Say for example, your bamboo. Now, bamboo you will have to cut itself. That means you are taking away the bamboo. Wheat itself, the whole crop is removed. So therefore these are not bearer plants. But say for example, coconut tree, so the tree remains and you only take the coconut. Your mango tree, the tree remains, you only take the mango. So these are your example of your bearer plants. Okay. Now, when do we recognize a PPE? You will recognize a PPE, you will recognize as an asset only and only if two conditions are met. That means this is a and condition, this is not a or condition. So your first condition is if the expected future economic benefits, if the asset gives you expected future economic benefits and whose cost can be measured reliably. If the economic benefits, you expect any economic benefits and whose cost can be measured reliably, only and only then you will recognize an asset. Okay, now the question comes, what will be the initial recognition? Initial recognition is when you purchase the asset. So when you purchase the asset, the initial recognition will be at cost. And your subsequent recognition means that is what you do on balance sheet date on 31st March. So initial recognition is at the date of purchase. This is at the date of purchase or your manufacture. That is your initial recognition, and subsequent recognition is that is at the balance sheet date. So over there you have two options. You can either do it at cost, or your second option is you can either do it at revaluation method. Great. Now, when we say cost, what exactly do we mean by cost? So, cost includes first of all your purchase price, that is the price that you have paid to purchase the asset. Any non-refundable taxes, say for example, any GST which is not allowed. That means you will not be allowed a deduction, you will not be allowed a set off. In such a case, this amount will be added to the cost of asset. So, therefore, any non-refundable taxes. Any installation cost, any you purchase a big machinery and you have to install it in the plant, any installation cost will also be included at your cost. Any site restoration cost, say for example your business is a mining business, so you have to dig the entire land, and after say for example 40 or 50 years you have to restore the land, because if you leave such a huge pit someone might fall. So what does the government say? Ki, no boss, you have to leave the land as you had gotten it, so you have to restore. So site preparation cost will sorry, that is your site restoration cost. This will be a site preparation cost. That means you are getting the land ready for the asset. Any cost of testing, that means you are testing whether this is okay or not. But whatever products you make and you sell these products, so that will have to be reduced. So therefore your cost of testing minus your sales, that means cost of testing net of sales. Okay. Any initial delivery and handling cost will also be added. This is what I was talking about, present value of dismantling and site restoration cost. This is the mine example that I was telling you, that the cost that you will incur to get the land to the same condition that it was there before. Any import duty that you pay, say example, you imported the machinery from outside, so any import duty you pay, this will be added to your cost. Then is your professional fees. So your professional fees is any, if you paid, for example, a professional fee to someone to check whether this land can have a building of what height. So you'll be paying some professional fees in such a case. This professional fee will also be added to cost. Next is your interest cost. Your major inspection cost. Your interest cost is, say for example, you've taken a loan, so the interest will be added. Any inspection cost, site inspection cost will also be added. If you've incurred any cost to make road or track around the plant, that also will be included in your cost. So these are your broad examples of cost. I have also left certain spaces. If you want to add your own cost, I have left some places for you to add it. Okay. Now something that you have to remember, or that they ask frequently, which items do not have to be included in cost. That means you do not have to add these. Any inauguration expense, say for example, your ribbon cost, all of that, that does not have to be added. Any relocation expenses, if you have to pay expenses for relocating employees, this will not be a cost. Any trade discount and rebate, this has to be removed from cost. If you got in any discount, that will be subtracted. Expenses post ready to use. So if you are manufacturing an asset, so the cost up till you are manufacturing the asset, up till it is ready to use, all of that will be cost. But any expenses, any cost that is incurred after the asset is ready to use, that will not be part of cost. Cost of staff training will also not be included, because if you are educating, if you are training the staff, that will not be included as cost. Initial operation losses, any initial operation losses, that means you are running the plant, say for example in the starting, and you are incurring losses, this cost, this will not be capitalized. Okay. So in case a part is replaced, so of an asset, in case only a part is replaced, so for example your asset is made of three parts and only one part is replaced, so in such a case you will de-recognize the carrying value of the old part. You will de-recognize, so your carrying value of the asset, and you will only de-recognize, that is you will remove, you will credit the asset with only the value of the part that is replaced, and recognize the cost of the new part. So you are just removing one cost and putting the new cost, that is cost of the new plant. Next, in case of construction of assets, so if the asset that is there you are not purchasing but you are making it on your own, capitalization of cost stops once the asset is ready to use. If you remember, over here also we studied the same thing in the red circle, that is any cost post ready to use will not be capitalized. Any income from asset before the asset is ready to use, if the asset is not ready to use but you are earning any income, in such a case this will be credited to P&L. Now say for example you are making a building, but right now the building is not complete, so the floors you have lent it for parking of cars. Okay, so till the point your building gets ready to use, you have made it as a parking. Now such a case, whatever amount you receive from the use as a parking, this will not be subtracted from cost of asset, but this would be rather credited to your profit and loss account. Next comes your deferred payment. Deferred payment means, say for example, you are paying, your normal credit period is 30 days, or if your payment period over here, they have decided that your payment period, they have drawn a line at 12 months. So if your payment period is greater than or equal to 12 months, if your payment period is greater than or equal to 12 months, that means you have actually taken this asset on a loan. You are already using the asset, but you will pay this more after more than 1 year. In such a case, the cost will be the present value of the installment price. Say for example, you are going to pay, you have purchased an asset for 5 lakh, but what are the conditions that you will pay after 1 year, and you will pay one year each year. So now what will you do? This is your year 0. On this date you got the asset. On year 1 you will pay 1 lakh, year 2 you will pay 1 lakh, and so on. So if you have to recognize this asset, this will be recognized at present value. Okay, so all of this will be discounted. This will be discounted by 1 year. This will be discounted by 2 years, etc. And you will be recognizing it as at present value. However, if your payment period is within 12 months, that is 12 months of the sale date, then in such a case, the amount that you are paying itself will be considered as cost. That is, cost will be your full price. Okay. Next is your exchange of assets. Now, your exchange of assets. What has happened? Say, for example, I have a car and you have a machinery, and we decide to sell. So now in such a case, what will happen? I will give you my car and you will give your machinery, and I will also pay you some amount, say rupees 1 lakh. So in such a case, how do you determine? How do you determine what is the purchase consideration? So if this exchange of assets has commercial substance, then in such a case, what will be the cost of incoming assets? So see, we have to value the cost of the incoming asset, that is the asset that is coming inside our business. So what will be the cost? It will be, so if there is commercial substance, then your first priority will be to the fair value of asset given up. So what happened? I had a car and you have a machinery. I gave you the car and you gave me the machinery. So now what happens? Right now, which asset do I have with me? The asset that I have with me is the machinery. So therefore, I have to value what will be the value of this machinery. So in such a case, the first priority will be fair value of asset given up. That is, fair value of this car will be the purchase consideration for this machinery. Okay, what is the next? Fair value of asset received. That means fair value of the machinery. That means if I'm not unable to determine the fair value of car, then in such a case, what will I do? I will do fair value of machinery. So fair value of machinery will be the price that I have paid for the machinery. I will record it at this amount. And last is the WDV of the asset given up. So if I am neither able to determine fair value of this car, neither am I able to determine fair value of this machinery, then my last option will be the WDV of this car. WDV of this car will become my carrying value of this machinery. Okay. That, but if there is no commercial substance, that means if the transaction lacks commercial substance, in that case it will be the WDV of asset given up. That means WDV of asset given up will be my cost of incoming asset. That means this will be my cost of the machinery. Okay, so I hope this is clear with this example. Great. Okay. So now coming to our second part, that is your subsequent recognition. So now subsequent recognition means the amount that you will be recognized in on 31st March. So now subsequent recognition is of two types. You either follow cost model or you follow revaluation model. So if you follow cost model, what will be the value at which you will be recognizing? That is, it will start from cost of asset. Now cost is all those bubbles that we studied, the green ones, that is your cost of asset. And you will subtract your accumulated depreciation and you will subtract your accumulated impairment loss. For revaluation model also it is very very similar. Only differences, instead of this cost it becomes fair value. So over here also it is fair value on date of revaluation minus any accumulated depreciation minus any impairment loss. So this is your cost model and your revaluation model. Now next is treatment of accumulated depreciation on revaluation of asset. So when you are valuing assets via method of accumulated depreciation, that means every year, say for example, you purchased an asset for rupees 100 and every year there is depreciation of 10 rupees. The asset in the books will continue showing at 100 rupees. You are not touching the asset. What entry do you pass? You pass another entry of accumulated depreciation debit to P&L 10 rupees. This entry is passed each year and your accumulated depreciation keeps accumulating. So your cost of asset in books always shows at 100. This is your method of accumulated depreciation. There is another method where depreciation is directly hit on the asset. That means This year we will show at 100. Next year, when you have used 10, you will subtract 10 rupees in the form of depreciation, and this will be now shown at 90. This is your depreciation method. But the one that we are doing right now is your accumulated depreciation method. That means if the entity is following accumulated depreciation method, then how does how do we value, how do we account for a transaction when there is a change in the revaluation of the asset? Just a minor change you will have to do over here. Depreciation to asset, the entry, instead of this 30, this is 60, because the entry only does not match. Okay, so now say for example the asset that you purchased, its original cost is 100 rupees. Depreciation that has happened over the years is 60 rupees, and now your WDV, that is your written down value, is only 40 rupees. Now what has happened, this asset of 40 rupees is now revalued. Asset is revalued at 60 rupees. So in such a case, sir, how do I account for this increase from 40 to 60? How do I account? Because in my books, the asset is showing at 100. I am following accumulated method of depreciation. My asset is untouched. So now what happens? There are two methods. Your first method says कि we will do proportional proportional. What does that mean? That your WDV is 40. That means the original cost is 100. The original cost was 100 and now it is only 40. That means, what does that mean? That 40% of the asset is remaining. That means 40% of the asset is remaining. So if we were to see that 60, if the value of the asset is 60 now, so this is actually 40%. This is 40% of the whole asset. So if you do 60 divided by 40%, that means your what is 100% is basically what we are trying to find out. So if your 60 is 40%, what is 100%? What would have been the cost? So this gives you 150. That means your asset should be shown at 150. So in such a case, what do we do? Your asset in books is currently, the carrying value in books is rupees 100, because you have not touched the asset. I am repeating multiple times. So you will, asset will be debited by 50. That means 100 it was already there. So we are increasing its value by 50. Therefore we are debiting. Okay. Now how much is the increase in value? It has changed from 40 to 60. Correct. So that is a change of 20. So first you pass the OCI entry, that is your 20 rupees. So you've done, asset has been increased by 50. I hope you understood. We did that 60 is 40%. Then 100% is how much? So 100% becomes 150, because 100 is also 100%. So therefore to find the difference, 50 we have increased the value of asset. Your OCI becomes 20 and the balance is 30. That is your accumulated depreciation. Okay, so this is the entry you will be passing under method 1. That is your proportional accumulated depreciation. What does method 2 say? Ki, sir, you have already charged depreciation 60 rupees. So charge this to the asset and then we will revalue. So what does method 2 do? Method 2 does depreciation account debit 60 rupees to asset. Understood? So now we are touching asset. That means we are reducing the value of asset. Your asset was showing at what amount? Asset was showing at 100 rupees. Your asset is now being credited by 60 rupees. So your assets carrying value now becomes only 40 rupees. So your assets carrying value is now 40 rupees, and we have to increase from 40 to 60. That means we'll have to increase by 20. So therefore now asset will be debited by 20 and credited will be OCI, because we are doing the revaluation method. So whenever you are revaluing an asset, it will be transferred through OCI. Okay, I hope both these methods are clear. Next part comes is your revaluation. So your revaluation, say for example, there was an asset of 100 rupees. So if your asset was originally worth, if your asset's carrying amount, so if your assets was initially upward revalued. So say for example, your carrying value of the asset was 100 and you revalued this to 120. So in such a case, this 20 rupees will go to OCI. The 20 rupee difference will go to OCI. Whatever is the journal entry, asset account debit to OCI. Now this 120, if it is revalued again the next year, if this is revalued to, say for example, which example should we take? Say for example, it is revalued to 70. That means it is revalued even lower than 100. So now what do we do? The difference between this 120 to 100, I will use a different color or leave it. Okay. So between 120 to 70, what you have to realize is we will first have to stop at 100. So between 120 to 70, there is one stop at 100, and then there is from 100 to 70. So earlier 20 rupees you had recognized in OCI. So now what do you have to do? Again, this decrease of 20 rupees you will have to again reduce from OCI. Earlier we had increased OCI by 20 rupees. So now again this 20 rupees will go to OCI. This much part. This much part will be reduced from OCI. That is, it will be debited. OCI will be debited. And the remaining 30 rupees, that means from 100 to 70, this will come in your PNL. So PNL will be debited. So first, it will be OCI to the extent we did it upward earlier and balance to PNL. Okay, so this was when initially we had upward revalue, that means from 100 to 120, and then subsequent downward, that is 120 to 70. Okay, now let's see a different example. Ah, okay. So now initial downward, say your assets carrying value is 200 rupees. Initial downward was 170, and this was later increased to 250. So again, what will happen from 200 to 170? Whenever something goes up, first time we will transfer it to OCI, but whenever something goes down, first time we will transfer it to PNL. So this 30 rupees difference will go to PNL. Entry will be PNL account debit to asset 30 rupees. Now, when this asset is revalued to 250, again, this journey will stop midway. Between 120 and 250, this will first stop at 200. That means this 30 rupees will again be credited to PNL first. And then the journey from 200 to 250 will be sent to OCI. Okay. So if first we did PNL, then over here also first we do PNL. If first we do OCI, over here also first we do OCI. Over here balance will be PNL. Over here balance will be OCI. Clear? I hope this is very clear. Your frequency of revaluation. Frequency of revaluation, that means how frequently do you value your assets? It will be annually. It will be done annually. That is each year if it is significant and volatile changes. However, if there are insignificant changes, it will be done every 3 to 5 years. Next is your depreciation. So under depreciation, we basically have to identify when to do it and how to do it. So first is when to do it is when your asset is ready to use. If your asset is still not ready to use, asset will not be depreciated. All cost will be capitalized. Okay. So if your asset is already ready to use, then your depreciation will start. And when the asset is classified as held for sale, that means it is not sold. Even if it is just classified as held for sale, that means you have intention to sell this asset. That means as per SA, as per IND AS 105, that talks about assets held for sale. So if you have classified as an asset as held for sale, your depreciation will stop from that date. Now there are certain methods. There are certain methods for depreciating an asset. So that is, first is your straight line method. Second is your diminishing balance method, that is your WDB, and third is the units of production method. So what does straight line method say? Straight line method, under straight line method, equal amount of depreciation is done every year. That means depreciation is calculated at the original cost of asset. So your asset cost minus your salvage value. Asset cost if there is rupees 100 and your salvage value is rupees 20 and your useful life is 5 years. So in such a case, your asset cost is 100, your salvage value is 20 and your useful life is 5 years. So this will become 80 divided by 5, that is 16 rupees. Every year 16 rupees will be calculated as depreciation. Next is your diminishing balance method. Diminishing balance method does on your rate. So if, what does diminishing balance does? It does your rate of depreciation at the opening value of every balance sheet date. So say for example, your rate of depreciation is 10% and your asset cost is 110 and your salvage value is 10 rupees. So what will we be doing? We will be calculating at 100%. We will be calculating at 100 into rate of depreciation is 10%. So first year depreciation will be 10 rupees. That is 10% of 100. Now next year what will happen? Your asset is now showing at 90 rupees. So next year depreciation will be 90 into 10%, which is equal to 9 rupees. Now 9 rupees depreciation. So now your asset is not worth 90 rupees. Your asset is worth 81 rupees. Again, you will do 10% depreciation next year, which comes to 81 rupee, 8.1 rupees depreciation. Then again, this you will subtract, and this is how the process goes on. So under WDV method, your value of asset can never be zero. There will always be some value, even if negligible, but there will be some value. Okay. And last is your unit of production method. Unit of production method is your asset cost minus salvage value. So that is basically your net asset cost into actual units upon total capacity. Say for example, there is a projector. So there is a projector. So if you see, a projector's main cost is the bulb that is used in the projector, and the bulb has limited useful life. So say for example, the bulb has useful life of 10,000 hours. So if in year one I only use 1,000 hours of the projector, in such a case I have basically used only 10% of my total hours. So my depreciation will also be 1,000 divided by 10,000. That is 10% of my asset cost minus salvage value. If this same was, say for example, 4,000 hours, so then I will charge 40% depreciation in that year. So in every year I will see how much portion of the asset have I used up, and that much is the depreciation that I will charge. Okay, coming to your next part is your subsequent expenditure. Okay, before that we will do this. Any change in depreciation method or rate will always be a prospective effect. It will be a prospective effect. That means if, say for example, my depreciation rate was 20% till now, and from this year onwards I am doing it 10%. So now what will happen? All my previous years will be depreciated at 20%, and only from this year onwards I will depreciate it at 10%. So it will be a prospective effect. If the life of part, that means if there is a asset, if there is a huge asset, say the example life of asset is 20 years, but life of a part that is being used in the asset is only 10 years, that means you'll have to replace this part. In such a case, depreciate according to the life of part. Depreciation will be done according to the life of part. However, if life of part is greater than life of asset, that means if your asset is, say for example, for 30 years, but your life of part is 50 years, in such a case depreciation will be according to the life of the asset. So basically whichever is lower, that will be the life that we will be taking. Next is your subsequent expenditure. So subsequent expenditure, that means once the asset is ready to use, what do you do of the subsequent expenditure? So any subsequent expenditure, say for example you are driving a car and you crash that car. Now you have to repair that car. This expenditure will be sent to P&L, because this does not increase the life of asset. It is just a normal, or any, say for example, you have your car and you sent it for servicing or repairing that you do every year. So if it is any day-to-day repair, this will be sent to your P&L. Next, if it increases the life of asset, if you do some expenditure on the asset such that your life of asset increases, in such a case, this cost will be capitalized. It will not be sent to the P&L, because you are enhancing the value of asset. If it increases the efficiency of the asset, then also you will capitalize. Say, for example, I have a machinery that can produce 10 parts per minute. I put some technology in it. I invested some amount so that now it produces 50 parts per minute. So I have increased the efficiency of asset. Whatever amount I've spent, this will not be sent to P&L. This will be capitalized, because this will give me future economic benefit over the years. Next is if there is any major replacement. If there is any major replacement of the asset, any part of the asset. So in such a case, first the old part has to be de-recognized, and new part has to be capitalized. Last part of the chapter is any miscellaneous point. So if an asset includes decommissioning obligation means breaking down the asset. Then in such a case, and such asset is revalued, then compare the asset value with the revalued figure. So step one, basically calculate the WDV of asset, that is your written down value of the asset that is on in books in today, and provision for decommissioning. That is whatever the provision you are making for decommissioning, this will be post unwinding, because you will be recognizing this at present value. So whatever is the carrying value after adding finance cost every year. Then step 2 is WDV of asset minus provision for decommissioning expense. That is WDV of asset, that is the WDV that is being shown in the books today, minus the provision, that is the decommissioning expense. This will give you the actual written down value of asset, because there is some written down value, but you also have a decommissioning liability, so therefore that will be subtracted. So this is your actual WDV of asset. And step 3 is give necessary effect post comparing your step 2 and your revalued amount. Step 2 gives you your actual WDV, and this gives you a revalued amount, and then it is again the same. Any difference, if there is an increase, will be sent to OCI, and if there is an increase in the revalued amount, it will be sent to OCI, and if there is a decrease in the value, then it will be sent to PNL. Great. So with this, we are done with this IND AS, and I will see you in the next one.